These are the 7 things that you want to do if you're 55 years old and thinking about retiring soon. Not doing these 7 things could leave you exposed and underprepared for retirement, and that's not an outcome that you want. Number 1 is max out and take advantage of all the opportunity available to you in your current 401k plan. What does maxing out look like? There's brand new rules in 2025. They have changed this just a little bit. So ordinarily, if you're under 50 years old, you can contribute $23,500. Once you're over 50, you can contribute an additional $7,500 to get to now a $31,000 contribution maximum. Starting in 2025, there is a new catch-up contribution available to people who are between the ages of 60 and 63, and that number is $11,250, bringing your grand total to $34,750 if you're between the ages of 60 and 63. Those are the contribution limits. There's 2 views here. One is that if you're not taking advantage of your 401k, then you're leaving tax opportunity on the table. The advantage of tax compounded growth, potential tax-free distribution if you're using the Roth portion of your 401k. Those are very valuable, oftentimes more advantageous than using a taxable investment account, which is your alternative if you're saving over and above the thresholds that you're currently putting into your 401k plan. Maxing out your 401k plan isn't always enough, especially if you're a higher earner. We think about retirement savings as a percentage of your gross total income. So some people fall into that trap of thinking, well, I've maxed out my 401k plan, that's all I can do. That's really not the case. Just because you've maxed out, now we're thinking about what's the next step. Maybe you have an ESPP plan through work. Maybe you have after-tax contributions as an available contribution election in your 401k plan. If you do, it might be something to explore. There's lots of cool things you can do to convert that to a Roth plan inside your 401k. We're thinking about saving for retirement as a percentage of your total income. So just because you max out, that doesn't mean that's all you can do. There are these other steps that you do afterwards, but think of it like a priority. You're gonna max out the 401k plan first, and then you're gonna start looking at what can I be doing after that. Number 2 is charting out a retirement income plan for immediately after you retire. Going into retirement not having a retirement income plan is not a recipe for success. Identifying how much money do you expect to distribute from your savings in the first 5 years of retirement. Whatever that number is, earmark that, invest it in a place that's not volatile, that doesn't take on stock market level risk, because you know you're going to need that in those first 5 years. That allows you to have the remaining portion continue to stay invested for growth. Putting those concepts together, that's a recipe for success. Our view is that a structured retirement income plan is going to be the foundation of retirement success. It's also going to be a huge factor in helping you not feel this retirement angst as you're making this transition. You're going from working and saving and having a paycheck for 30, 40, maybe 50 years, to all of a sudden that's going to stop. And you're not going to feel comfortable and confident in that stoppage unless you know your retirement income plan is sound and also built to be sustainable over a 30-plus year period. Our second view is there's not one size that fits all when it comes to retirement income planning. The view or the strategy that we espouse is something called dynamic distribution, built around retirement portfolio guardrails and retirement asset buckets. There's the 4% rule. There's other views out there. I would encourage you to dig into those to see which one you feel like works best for you. We view the dynamic distribution strategy built around portfolio income guardrails and retirement asset buckets to be the best strategy. It's a bit more nuanced, but allows for the most income, especially early on in a retirement when you want to spend it the most, but also allows for 30-plus years of sustainability. The next aspect of a retirement income plan is how are you managing this from a tax perspective? So much of what you've made and probably saved is likely in a pre-tax bucket. Right? That's the 401k plan that came around 40 years ago. If you're watching this video, you're likely the 401k generation. How do you withdraw from that and keep as much of it as possible for you and send as little as possible to Uncle Sam, as is allowed via the tax code? You have a partner in this endeavor. Uncle Sam is your partner. If you have a pre-tax 401k, which is where the vast majority of Americans have saved their wealth, he has not yet had his chance to take what he says is his share. So how do you optimize the distribution of those assets to keep as much as possible in your pocket? How should you be leveraging Roth buckets and taxable investment accounts to pair with what is likely your largest bucket, the pre-tax bucket? Developing a distribution plan that's optimized for taxes likely involves taking pieces of distribution from each of those buckets and doing that every year, reassessing each year where should our distributions come for the next 12 months. That's a critical part of retirement income planning. Number 3 is max out your HSA plan. These are the triple tax advantage accounts that don't exist anywhere else. It's tax-free when you put the money in, it's tax-free while it grows, and it's tax-free when you distribute it. This is a huge deal. Healthcare is generally people's first or second biggest expense in retirement after housing. It's something you could expect to spend about $150,000, $160,000 on over the course of retirement per person. Fidelity puts out a study every year recalibrating what that expected cost is. They just put theirs out. 2025, we're expecting to be around $160,000 per person over the lifetime of retirement. An HSA can serve as a specific account that's tax advantaged for this large expense. Now, HSA strategy in general, well, how has it evolved? What does it look like? People use it in one of two ways generally. Some people put the money in and they take the money out over the course of the year. Things that like prescriptions and copays and CVS runs around basic household items for healthcare. The contribution limit for a family in 2025 is $8,550. That's the maximum you can put into an HSA. You have to be eligible to contribute, and your eligibility is based off of the health insurance plan that you have. People generally use their HSA in one of two ways. Some people put the money in over the course of the year and then take the money out. They use it almost like a revolving savings plan. They never really accumulate assets in there. That's okay. That means you're still buying qualified medical-related items or expenses with pre-tax dollars. That's a great place to be. You're not paying taxes on what you're spending out of your HSA. Other people take the approach of using the HSA as a retirement-specific investment account, contributing to the HSA, investing it, letting it grow, and then building up a separate investment account to complement 401k, Roths, etc., knowing that that accumulated HSA account is going to be used specifically for healthcare expenses in retirement, which they expect to be one of their largest expenses. Both strategies are okay, but if you're in the place where you have really good cash flow now and you can afford to pay maybe what are low medical bills because you happen to be healthy at this stage of your life, pay it out of pocket. Let the HSA grow and do so in a tax-advantaged way, eventually allowing for tax-free distribution later on in your life. Number 4, review your existing life insurance and disability insurance coverage. Insurance is a key part of financial planning. It's risk management. If a catastrophic loss happened, do you have coverage to make it so that doesn't totally upend your plan's success? Depending on where you are in life, your need for disability and life insurance coverage is going to wax and wane. I'm 37, I have an almost 2-year-old son. My need for life insurance is really high. As he ages and we have more savings, we're that much closer to retirement, my need for life insurance should in theory decline a little bit. It never goes to zero, but it should decline. So as you get closer to retirement, assess, is the coverage you still have in place required? Could it be modified downward? Do you need it? You likely still need some, and I think a lot of people sometimes get into the trap of thinking, well, I only have 10 years left to go and work, I probably don't need my coverage anymore. There's still going to be an enormous financial impact if something happened to you, at age 55 and your target was retiring at 65. 10 less years of saving income. That would have a huge impact on your spouse. The point is you need to review it. A lot of people in corporate America are using life insurance coverage through their employer. They have group coverage. Group coverage is priced in 5-year age bands. So especially once you get to the age of 50, and if you're healthy, the group coverage is usually not a great deal anymore. So if that situation is yours and you're 50 and you're using the group coverage, shop out a private coverage policy. It's not going to be tied to your work. The price will be fixed. It won't go up in another 5 years, and you've now locked in your health. So those are 3 good reasons to potentially look at replacing your group coverage. And one thing that you can oftentimes find is if you're healthy, it will actually be cheaper and a better policy. So that can be a home run win for people. The second thing we're talking about is disability coverage. A lot of disability policies only pay until the age of 65. I have disability insurance because at age 37, I have a long way to go. My biggest asset by far is my ability to earn a paycheck. So if something happens that impairs me from being able to do that, my family's in a lot of trouble. I have to protect that with disability coverage. Now, when I get to be 55 plus, I'm that much closer to retirement. I have that much more in savings. So if something happened to me, we'd be able to self-insure that risk quite a bit more than we could today, right? So as you get to this stage of life and 55 plus, you're starting to think about, do I still need the same coverages that I have in place today? Should they be modified? Should they be canceled? Or maybe you don't have the right amount and they might need to be added to. But the point is you need to review it. Number 5 is reviewing your investment mix to make sure that you are ready to retire. We touched on this a little bit in section 2 around retirement income planning, but it's really, really critical. Identifying, again, how much money do you need in those first 5 years? Make sure that's protected. I'm filming this video right now in February of 2025. Markets have heightened valuations. People are a little on edge. Does it make sense to be taking a deeper look at that investment mix to make sure that this is still the mix that makes sense for you at this stage of your life? There's very oftentimes a big disconnect between how much risk someone thinks they're taking on, what they're actually taking on, and what they need to be taking on. That risk capacity, that last one, is something you should think about. If you're retiring at 60 or 65 with the trend in longevity, there might be a scenario in which you're retired for 30 to 40 years. That's a long time to not be taking a paycheck. Maintaining assets in growth investments is critical. It's going to help you hedge longevity risk and inflation risk. And those are two big risks to retirees that a lot of people really don't think about. So those are two mainstream views in financial planning that I really align with, is identifying what is the need that you're going to have for distribution. So these first 5 years of retirement, let's earmark those assets and investments that are lower volatility, less risky. But then also, what we can't ignore the fact that we still need to maintain growth assets through the duration of our retirement, right? If you're having a 25, 35, 40-year retirement, we need assets that are going to keep pace with that income need later on in your life. But having a short-term bucket, that's going to allow you to sleep at night. No matter what the market does over these next few years, you've intentionally set aside these dollars specifically to be used for distribution in these next 5 years. You'll feel your growth assets go down if the market were to decline, but this other bucket you've set aside, that shouldn't have that same level of volatility because you knew this is where the money was going to come from. Number 6 isn't the dollars and cents of financial planning. It's about this life transition, and it's a big one. What are you going to do with your time, right? Finding that next passion, finding something to fulfill you. If your retirement is just laying around watching YouTubes all day, that might not be a fulfilling retirement. That might not be a healthy retirement, right? What does this next chapter of your life look like? And that's really, really key. When you've been working and getting up and having this purpose every day for 30, 40 years, and then one day it stops and that change is implemented, it's a big transition. And that's exactly the right word. It's a transition. You're going to adapt to it just like everybody else does, but you will have this intermediate period that you might struggle a bit, and that's okay. So whatever you can do to prepare for that in advance, charting out what does my first year of retirement look like, pre-scheduling your trips, things like that. Those are helpful exercises to help you through this transition. It's a life transition just as much as it is a financial transition, and both can be anxiety-inducing. Financial planning helps alleviate the stress around both of those things, and I think is a key part of the financial planning and retirement planning process, identifying what does this next chapter look like, and most importantly, communicating that with a spouse or partner if you're going through life doing this transition with someone else. Lastly, number 7 is considering a Roth conversion. Does it make sense for you to be converting assets from your pre-tax accounts into a Roth account to allow for tax-free distribution when you do retire? Again, the vast majority of America's retirement wealth is tied into pre-tax accounts. Does it make sense to pay taxes at today's historically low rates to make it so you don't have to pay tax again in the future? This should unlock for you the flexibility and choice to make tax-free distributions that do not show up on your tax return. What your tax return says your income is determines a whole host of things in retirement. It determines what capital gains tax rate you pay, how much of your Social Security is taxed. Do you pay tax on a state level? State by state has different rules around this. Do you qualify for a health care tax credit if you need health care before the age of 65? All of these things are based off of what your tax return says your income is. So if you have a place that you can withdraw from that doesn't show up on your tax return, that could be really helpful in that. The key is that this doesn't apply as a blanket concept for everyone. You need to have a visualization of what do my tax rates look like today? What do I expect them to look like in the future? When you put those pieces together, that will inform you as what should your Roth conversion strategy be. Should you do it now? And for a lot of people, some of the best years to do a Roth conversion are in the years right after they retire. So looking at that as it makes sense for you and building out your plan for it would be a great way to go into this next chapter of your life in your financial and retirement planning, having an idea of what Roth conversion could look like. I hope you enjoyed this video today. I would encourage you to sign up for our Retirement Readiness webinar series. We do this once a month where we dive deeper into relevant retirement topics today to help people as they approach this next transition stage of their life. If you have questions that are more specific and individual to you, we also offer a complimentary 30-minute consultation where we can dive a little bit deeper into what you're doing and start thinking about ideas of maybe this is what you should be doing to better position you for a tax-efficient, flexible, fun and fulfilling retirement. If you found this content helpful, you found it informative, awesome. Subscribe to the YouTube channel, connect on LinkedIn. I'm going to be putting out more content just like this. If you have other questions that are a little bit deeper that I wasn't able to dive into in this video, or you have questions about how it pertains to you individually, awesome, totally okay. Go to the link on my website. There's a space where you can book some time with us. I'd be happy to talk to you about it. Help you as much as I can. It's complimentary. I'll point you in the right direction. If you have other questions, we can tackle those too. Thanks so much for joining us. Have a great day.